Good afternoon, participants. We'll be waiting for another 2 minutes to join the other participants. So then we can start the call. Yeah. Good afternoon, everyone. My name is Suresh. Today I'm the a moderator for the quarterly update of ASK Specialized Portfolio. With us, Mr. Gagan is there. Gagan have a very rich experience in the equity market. It's about 18 years of the experience. So before joining with the ASK, he has worked with the good reputed firms like BNK Securities and Paris-based AMC, as well as the couple of the equity broking firms. So he is managing this portfolio. Today, Gagan is with us to take to give us about the what happened the last quarter about the portfolio, as well as the what are the changes he has done in the portfolio and their view also. And participants, I request you, we have any question and answer words after the update from Gagan, so that you can keep on typing the questions and give it to us, so that we will take those questions. With this, I will just hand over to Gagan. Gagan, take over. Thank you.
Yeah, good evening, everyone. Thanks for joining in. I will run you through a brief presentation, to highlight the key developments both at the industry sector level and also at the portfolio level, and then we'll go into a question and answer session. Yeah. Yeah. So. Yeah, so to start with, a basic rundown of how the industrial developments have happened. So in the bygone quarter, the steel and cement consumption growth was healthy. Obviously, an indicator of the strong capex-led developments that we've seen both in power, railways, and in the defense sector. Also, strong construction activity pertaining. And on the other hand, the consumption demand remained fairly muted even going into Q2. Companies like Page Industries did not see growth. And obviously, there were consequently inventory run up. And on the IT and chemical segment, which have significant export salience, both the segments were rather weak. Chemicals is impacted in a significant way by pricing, and specifically so in the agrochemical segment, where there seems to be very high global inventory levels and consequently very sizable pressure on pricing. Same phenomenon visible in the intermediates, the pharmaceutical and chemical intermediate segment, where China has resumed supply in a big way. And this has also led to inventory losses for companies which had stocked up for 4 to 6 months of supply. And in IT, again, the weakness in conversion of deal wins to revenue persists. The slowdown, which started with the banking and financial services, percolated down to the other segments, high tech, semiconductors, utilities, consumer retail. All of these segments across most IT companies are sort of seeing a slowdown. Paradoxically, in IT, the total contract value of new deal wins is actually rising. But this is being offset by the existing deal renewals not happening to the full extent. There is a leakage in renewal of existing deals. There is a pause in activity around cloud and digital exposure, where there was an extra normal run up in the past 2 years, and that is softening. So overall, it seems that IT will take some more time, before things sort of recover back. And on the manufacturing side, softer logistics and softer input prices have helped margins. In fact, this is visible in the pharmaceutical industry as well. When I say pharmaceutical, I'm referring specifically to formulations, both domestic and export. The API business, on the other hand, has seen pricing pressure. The agrochemicals was weak, both exports and domestically. Exports because, as I pointed out, there was global overstocking, and at the same time, because of the movement in interest rates in North America, distributors wanted to keep lower inventories. They are also faced with a continuous fall in ag chem prices, so they want to take advantage of that as well. And this is impacting large Indian companies which export, like UPL, Sumitomo, in a big way. Finally, the geopolitical situations that you see in Israel and Russia are key monitorables as far as basic movement of critical imports like crude are concerned. And so also the outcomes of the election we've already seen at the state level and subsequently at the national level. Q2 highlights across sectors. We discussed, the capex segment is doing very, very well, visible in strong growth in companies, which cater to defense to power. We are seeing coal-based power-related ordering, talks of that also moving up, 20 to 30 gigawatts of our coal-based power pipeline over the next 4 to 5 years. Strong order inflows in the defense segment, and reasonably healthy cement and steel consumption. The financial segment, a mixed bag in the quarter. The AUMs and advances grew healthy for most of our holdings, north of 25%. But there was NIM contraction, which was more than anticipated or more than guided for by the companies. The cost of funds has gone up year on year, and companies have not been able to pass it on to the extent that they would have liked to. And incrementally, the asset quality has deteriorated, albeit very marginally. So slippages are up, but marginally. The chemicals, pharma intermediates and API had a fairly weak quarter, which we've already discussed is down to very poor pricing in many segments, down to a slowdown in the agrochemical segment. If you look at the commentary emanating from global contract manufacturers like Lonza, Wuxi, they are also given out profit warnings. Latest was Wuxi with a very, very significant profit warning. There's a biotech slowdown due to a shortage of funding or a slowdown of funding to that segment. So that's also impacting the intermediates and API business. IT again, already discussed, the TCV is going up, but slippages or leakages in renewal of existing deals is impacting the companies. Consumer segment remains weak. Autos and auto banks have been reasonably healthy, and pharmaceutical formulations have done very, very well. That's down to a very good situation as far as pricing is concerned in the US generic market. Whether or not that sustains is an open question. Very likely that it will sustain for some time to come, and then with increasing competition from Chinese and Bangladeshi companies, it might deteriorate down subsequently. So coming to the fund's performance, year to date, we've managed to hold outperformance vis-a-vis the benchmark. This is the performance of the portfolio vis-a-vis the index for the quarter. Sales growth has done better. PAT growth is at parity with the index. But for the year FY24 and 25, we expect PAT growth of the portfolio to be higher than the index. Just one comment here on this slide: the PE ratio that you see is on the higher side. We were faced with the dilemma of how to adjust for the very steep and sharp jump in the performance of one of our new entrant portfolio companies, IOC, where the swing from last year to is inordinately high. Obviously, if you adjust it for cyclical variations, it normalizes and normalizes the PE as well. So inclusive of that holding, the PE would be closer to 35 for 24 and around 25 for FY25. Yeah. This gives you some idea of our sectoral exposure vis-a-vis the index. You can see we have an over-indexed position on the infrastructure and engineering side, and under-indexed on the IT and telecom space. And this slide gives you a flavor of the portfolio actions that we've taken in the quarter. So we've got 4 new companies in the portfolio: Sirma, HBL Power, Indian Oil, JSW Infra, and we've made 2 exits, which is Infosys and Gujarat Gas. We discussed the sort of lengthy recovery that the IT sector seems to be going through, and while the TCV growth is strong, it doesn't filter down, or doesn't yet seem to filter down to revenue growth. And consequently, we decided that it's better that we exit because there were opportunities with better prospects. Gujarat Gas, the same situation. The steep movement in the prices of gas led to a shift to LPG, which impacted volumes, and Gujarat Gas had sizable exposure to the industrial companies which moved to LPG. That adverse spread between LPG and imported gas continues, and consequently, we decided that Gujarat Gas also is something we need to exit out. As far as addition into the portfolio of these companies, Sirma in electronic management services, electronic manufacturing services on a contract basis. That's the core business of the company. The promoter, the Tandon family, has a very storied past in this segment. The current promoter's father was the head of IBM India, and at some point in time in mid-80s, they ran the largest floppy disk component business, servicing the IBM group globally. And the current business lines are largely centered around printed circuit board assembly and a limited amount of design and manufacturing activity. And subsequently, they intend to get into outsourced semiconductor testing and assembly as well. So this is a sector which is growing, and that is visible in the strong order book of the company and the strong top line growth. What has happened in the recent past is there has been some margin deterioration for Sirma, and that is largely coming from their mix. The consumer segment is the one which is growing the fastest for them and has relatively low margins. Margins are higher in medical devices and in industrial segment, and they've signed up a multi-year contract with US utility, which will increase the salience of industrial as well exports. Therefore, margin recovery is in order. And they've also acquired a medtech company based out of Jaipur. The company has US FDA approved products in the pipeline, which can be scaled up with Sirma's assembly and manufacturing capacity, which is in the process of being doubled. So a sunrise sector with a lot of government focus, with the intent to get strategic independence from China-based sourcing, a play on China plus one in a big way, and also on PLI benefits. So we thought it a good fit for the portfolio. The second is HBL Power Systems. Again, the promoter is a technocrat, with education from IIT and MIT. The mainline business of HBL used to be in industrial batteries. So they are suppliers for telecom tower batteries, and that is in the lead acid category. But they are also suppliers of nickel cadmium batteries for industrial applications, and PLT batteries and nickel cadmium batteries for railway and data center applications. Interestingly, they have through in-house R&D developed products for train collision avoidance system, Kavach system, which you would have heard of, and they are among one of the three qualified Indian vendors to the railways for this. So this is a very sizable opportunity, and HBL already has got a decent order book from this. Compared to the size of the company's current turnover, this is a very, very scalable and sizable opportunity with better margins than the traditional business. At the same time, the traditional business itself is seeing an upturn because of demand from the data center and 5G implementation, which requires larger battery sizes. Because of the good demand environment, the pricing has also improved. And at the same time, there is a softening of nickel prices, which has also helped. So you'll see that in the last 2 quarters, HBL's mainline business has seen very sharp growth and also very sharp margin improvements. Part of it is also coming from them adding to their export base. They've added companies like Siemens, ABB to their list of companies to whom they supply. And exports will continue to grow. Domestic piece after a couple of quarters in the traditional business will grow, but albeit at a lower pace of around 9 to 12%. But the growth will remain higher in the PLT batteries, the defense-related battery segment, and the nickel cadmium batteries, which are relatively higher margin business for them. And thirdly, they've also entered into electronic fuses for defense applications. They've also acquired a 35% stake in a company called Tonbo Imaging Systems, which is a reputed name in night vision devices and electronic imaging systems for tank applications and for army applications, and also suppliers of missile seeker and sensor systems. So, a very scalable opportunity in defense-related markets also opening up for HBL. And finally, they are in the process of trialing their package of motor come drive for converting heavy commercial or MSCV and heavy commercial vehicles on the electric vehicle platform. And that could be a subsequent option value in HBL. So strong growth pipeline, strong addition to revenue from 2-3 new businesses, and therefore we thought it an interesting opportunity and added it to the portfolio. Indian Oil, again, a company which is seeing, this is the largest refiner in India. The current supply-demand environment, as far as we can understand, because of limited amount of supplies, at least at the global level coming through, will remain in favor of suppliers, and therefore GRMs are expected to remain very, very decent. The Indian government's also not sort of putting in knee-jerk reactions to crude movements and letting the GRM sustain. The company is coming up with a sizable capex getting commissioned in the next 2 years, trading at very reasonable valuations. Consequently, and also with possible deleveraging once the capex comes through, and consequently we've added IOL. JSW Infrastructure we've taken in the IPO. We like the story around the captive growth of the JSW group, which feeds into their ports business, which is housed in the JSW Infrastructure. So multiple years of high double-digit growths possible, but we were not able to build out an optimal position. We've got a small position of around 1.5% odd, and the stock has run up fairly sharply. So we are in the process of deciding to liquidate this one, because it's very suboptimal, and we were unable to get it post the IPO to the size that we wanted, because the price run up was very sharp. Infosys and Gujarat Gas we've liquidated. So this is largely the earnings growth trajectory for Nifty. The portfolio earnings growth stands at a 28% CAGR versus 19% for the Nifty. The valuations obviously are at a premium, but given the current circumstances, perhaps they're likely to sustain higher than long-term needs. Yeah, so that covers my presentation, and we can do a Q&A.
Thank you, Gagan, for the explanation and in terms of the portfolio, what are the stocks you added. That will give the clear picture on what happened in the last quarter with the exits and everything also. Participants, I request you to keep on type the questions in chat box and everything. So that we'll wait for 30 seconds, then we'll take the questions to the Gagan. Like I can see, one of the common question is coming on the system is, I think everybody knows about the market levels. which everybody as Nifty has touched the all-time high. Most of the mid-cap indexes, everything has touched the all-time high. So they're asking, what is your view on this in terms of the to take the any additional investment on the right time, or should we wait for any correction, or what is your view on this? Is the common question which is coming on the chat box.
Yeah, I understand that's a bit of a dilemma. All one can sort of say is that the while the multiples are high, there are pockets where they are justifiably high. Uh, uh, the if you look at certain pockets where there is very high growth potential, and that we've already discussed to a certain degree, which is uh, defense segment. If you look at the developments, very large AON recently announced of 1.5 lakh crores for HAL. BDL's order book is north of 20,000 crore. They talk of more than 20,000 crore of order intake in the next 3 years. BEL recently talked of upgrading its order intake prospects for FY24 from 20,000 crore to 25,000 crore. They've already done 18,500 crore as of date. So clearly there is momentum here, and because of this momentum in this segment, in the power and industrial segment, also in certain pockets of auto component segment, where you'll hear companies like Craftsman and Ramakrishna Forging talking about secular opportunities. Companies like Dana and Caterpillar talking of outsourcing in multiple year take-or-pay contracts to these companies, castings and forgings, because it's with the new wage rate in US, and given the EHS practices they have to follow, getting unviable to do there. So a secular opportunity in these sectors, a secular opportunity in semiconductor related manufacturing or electronic related manufacturing in India. In these sectors where there is a very long runway of growth and very sizable addressable opportunity, multiples perhaps will sustain at high levels, as far as I can understand. That's one way to look at it. Look at pockets where growth is extremely high and can justify the high multiples. Are there pockets where growth is versus the valuation dilemma is inordinate? There are pockets in mid caps where that could be the situation. IT, multiples are at long term means, but the growth seems to be still some distance away. So while valuations are not demanding, there's perhaps still a couple of quarters more before things start moving in that sector. Chemicals is actually facing a high pressure on pricing. More interestingly, one of the companies indicated to us that the Chinese government is incentivizing their intermediate and agchem manufacturers to the tune of almost 30%. So that's a very material arbitrage, which is very difficult to cover up. So in certain pockets of the chemical segment, there is a fundamental development which which is impacting them. The other is obviously the transient impact of excessive inventories in the channel. So mixed commentary there, and where the impact is fundamental, perhaps we should be a little wary and a little worried about valuations, right? And consumer, going through a lean patch, and probably will continue to go through a lean patch for some more time to come, till household balance sheets have to fight through the inflation and also come back to a certain level. So, I wouldn't paint everything with a broad brush. There certain pockets are justifiably high valuations, certain pockets, undemanding valuations, but with an obscure sort of outlook to the market. The other way to look at it is large cap versus mid cap, and clearly, valuations have converged, and perhaps there could be a certain amount of rebalancing towards large cap versus the mid cap.
Thank you, Gagan, for the detailed answer. So as you mentioned the valuations, so Mr. Sanchet is asking about on the same point. Basis the 1 year forward PE chart, what you have shown on the Nifty, are we expecting a mean reversion on short-term basis?
Steve, it's a hard one to answer. If you go completely by the book, there should be a certain amount of mean reversion, simply because valuations eventually at some point in time have to converge with earnings growth. But if you then look at it, twofold. Today you find the domestics are sort of taking profit, whereas the FIIs are now sort of filling in the gap by investing. They are compelled to look at this country vis-a-vis all the alternatives that they had, which are incrementally even in the East Asian markets deteriorating somewhat. So money flow, which is a difficult element to track, somehow seems to still be holding out. And as I indicated, it therefore, plus the fact that the government has very clearly spelled out its intent of going for GDP growth through a capital intensive, manufacturing intensive route, because the multiplier there is supposedly higher. We are seeing improvement in GDP growth rates quarter by quarter. So macroeconomically, things are improving. The government has the headroom for keeping the capex momentum going, and which will eventually feed into the private sector capex also. So it may not be a situation where the valuations may correct by very much and go back to 5 or 10 year means. There might be a pause every now and then, but I don't see a very sharp correction happening.
Thank you, Gagan. So as you mentioned the chemical sector's point of view, the Harshavardhan is also on the same thing. Is it a right time to increase in exposure to specialty chemicals, given the sector has given a subdued performance, as you mentioned, because of China is dumping all those things? So are we looking into the adding of those into the part of the portfolio?
So let me put it this way. When you look at chemicals, the areas that we would be interested in chemicals are areas where you have visibility from multiple year contracts, under the contract manufacturing or custom synthesis route, or you have a situation where pricing has normalized and competition is limited. Whatever commentary we are able to hear, for example, if you look at the commentary from Navin Fluorine, it started with the HFC volume offtake by the customer being sort of curtailed down by 25%, subsequently unscheduled plant shutdowns. A lot of Indian companies, not only Navin Fluorine, are exposed in a significant way to the agrochemical sector, because they supply intermediates to the agrochemical sector, whether it is Navin, whether it is SRF. The agrochemical sector if you hear UPL's commentary, or for that matter, global biggies like FMC or Bayer's commentary, will take at least 2 more quarters. In fact, some of these companies talk of even one full year before this whole thing normalizes. Uh, so this pain in the channel will remain, and so to that extent, the businesses will still struggle for at least some more quarters, 2 to 4 quarters possibly. Those that are exposed to the API part are also struggling, because the API businesses are also seeing price erosions incrementally. We've seen that in portfolios of Aarti drugs, in portfolios of DV's, generic API. So, and that needs to turn around before the chemical companies sort of get to benefit from that. In ref gases also, we've seen, pricing getting impacted. So we would like to double down on companies where the growth visibility is high, but maybe we would like to time it. So perhaps Naveen is something we would keep a close eye on. Maybe take a quarter or two and possibly add to that position. That's how I would look at the chemical segment.
Thank you again. Okay, as you mentioned, the growth perspective, everything is good. And the question which is coming is the recent entrants in our portfolio, whether it's HBL or SGM of the Sirma or IOCL point of view, all are we are entering at the peak of their prices. Okay. Will you see that substantial growth from here on the prices in line with the earnings, so the both will match, is the point. The question is just coming from the participants.
Yeah, for most of, in fact all of them, we are perhaps barring one, we are fairly in the money on 3 of those investments. So I wouldn't say that we caught them on the top. HBL, we are decently in the money. So also in IOC valuations are undemanding still. JSW, we made sizable money. Unfortunately, we didn't get the optimal position. Sirma is the only WIP investment among these 4 new investments, and it's a secular and long-term opportunity. Clearly, they are attempting to navigate the margins to a better level through acquisitions, through additions of clientele in exports business, and the opportunity remains sizable. So as things stand, we are comfortable on all of these 4 investments.
Excellent. Thanks, Gagan, for that. Gagan, if you look at the question which is coming on our sector point of the consumer staples, where we are having a good percentages of the portfolio, where you see in the overall picture on the consumer staples are struggling because of the rural growth is not up to the mark. At the same time, the rainfall also had a deficiency. So how we are going to play on that sector in the portfolio? If we have because the overall growth in this sector, what is your view?
Yeah, so we have exposure to one FMCG, and one in the paints, and one is more of the retail business page. On our FMCG investment, we are comfortable. They are, their main contributor to profit is their foods business, which is growing well, anywhere between mid to high teens at very decent margins. They're adding new categories. Their aspiration for scaling up their existing biscuits business is fairly strong. They've actually doubled their retail touch points in the last 1 year. Where they have sort of been impacted in the past few quarters is the spreads or the margins on their edible oil business, which is quarter by quarter actually improving. If you see, the losses are coming down, and their recent commentary is that in the next 3 quarters you will actually see things moving from the red to blue, and there'll be and in the coming year the spreads will normalize. So the commentary there seems to be reasonably strong. At the same time, they are also talking of scaling up their plantation business very strongly. It's 1,100 crores today with almost 16-17% margins. And more importantly, from a strategic point of view, they intend to insource their input requirement, which is fresh fruit bunches of date palm for the palm oil, and over a decade, insourced to almost 70%, and therefore inoculate that portfolio from price volatility related to imports currently. So it's on a good wicket, that business, and we'll continue to hold unless we find the price versus value equation distorted there. On page, the business is struggling for growth. Clearly, there, it all started with the initial huge sort of uptick in innerwear and athleisure during the lockdown phase, and subsequently, obviously, as things normalized, the demand there petered out, and it's still not recovered, and it's also impacted by down trading. So Page is struggling for growth, and while their distribution aspiration would indicate that they intend to grow at early double digits, currently their inventories are high, and their growth is not picking up. So that is something where we have rebalanced somewhat, and we are actually thinking of rebalancing, perhaps even completely, sort of liquidating the position. Yeah, so that's on the consumer piece.
Thank you. So I think the second question on the same page industries only you covered almost on that part. So the question which is asking about Sanjay is, as the entire the news articles and entire the things which is talking about the EV market. So the everywhere the future prospect of the EV market is looking very, very significant growth. So are you looking into that to add into more space, or how we are going to play on the segment?
So see, we have a couple of indirect plays in the EV segment. One is clearly, Sirma is a potential, EV play, because they have the auto segment also to whom they supply. While they have talked about that as a potentially large space. That could be one way of playing it. We don't have a direct sort of exposure to the EV segment. The potential other way of playing the EV segment that we have is through HPL. Once their prototype of the EV conversion kit for MHCVs and HCVs goes through the trials phase successfully. They have actually been approached by a couple of OEMs who are interested, because the sourcing from HBL could be more competitive for these OEMs vis-a-vis sourcing from China. So as of now, those are our sort of limited possible plays to the EV segment.
Thank you, Gagan. So the customer, Mr. Yogesh, is I'm a completely moderate investor. So if I'm going to how much equity portfolio for next 5 to 6 years will generate, and I think it was mentioned which sector for GDP plus inflation benchmark. I think I'm understanding like this of this question, how much you will generate about the returns next 5 to 6 years compared with the GDP plus inflation as a benchmark. I think will you able to answer this, Gagan? I think is very difficult, as how much is always. I think what in which way we can predict if the customer is going to stay in 5 to 6 years on the specialized portfolio, what type of returns he can expect as a moderate investor in this portfolio.
That's a hard one to answer. You know, all I can say is that we positioned our portfolio in what we consider as high growth areas, and clearly, that reflects in the earnings growth of the portfolio. At the same time, as one previous participant indicated or sort of contemplated that, you could see either a time correction in valuations possibly, or even in patches, an absolute sort of reversion towards long-term averages, though not fully, in my opinion. So what we can at best say or hazard is that earnings growth adjusted for mean reversion of multiples would be a reasonable way to look at what would be the return that one could make on this portfolio in a 5-year time horizon.
Excellent, Gagan. I think Yogesh answer has been also Yogesh question also has been answered. See, one more common question is coming from the participants, Gagan. I think very hard to tell, but as index funds today, if you see that wherever the index funds are generating any very good returns, as an active fund manager, so how can we surpass the index to see the or specialized portfolio in the long-term point of view? So should I is putting in such a way that should I come to the index funds or should I come to a specialized portfolio indirectly? So in which way we can answer you?
So the intent behind running an active and reasonably concentrated portfolio is to create potential for beating the indices, and perhaps over the longer term horizon and even at the year to date level, we've been able to do that. That's all I can say, that the idea behind creating a 15 to 17 stock portfolio with relatively higher concentration in positions versus the index is with the deliberate intent to have a better risk reward equation, and at the same time sectoral allocation, and within that stock selection is also with the intent to position in high risk high reward versus risk sort of segments, and that would be the endeavor to do all of that and try and beat the index and make it worth the while.
Good. Again, in terms of the, can you just as you've been talking about the good about the pharma point of view in the quarterly earnings which was mentioned, but the customer, one of the things is asking, we are not part of any pharma stock in our portfolio. Is there any specific reason for that? Is the question?
No, so we would like to take exposure in the pharma sector also, and we've shortlisted some names. Perhaps we're waiting for some opportunity of being able to enter at the price that we would want to. So see, first of all, as far as playing the pharma segment goes, we don't intend to be in the API space. It's very cyclical, and perhaps you could play it as a trade more than as an investment. The CDMO or the contract manufacturing piece, as I indicated, currently is going through a downward shift. Even if you look at the results of Indian companies like Suven and Syngene and their commentary regarding the future on CRO and CDMO, it's a mixed bag. So those are also segments which we think is perhaps not the place where we can position ourselves. High predictability and reasonable growth is available in the domestic business, and as of today, reasonable growth is available in the US generics piece also, though predictability obviously is much lower. Because the regulatory issues, that these companies have faced and continuously seem to face even as of today, would require better margin of safety. So, by elimination, therefore, if we want to play pharma, we want to play it in companies which have higher salience of the Indian or in the overall piece, at least the branded generic market. We identified a couple of names there. We would like to position ourselves there once we are there at the price which we think risk reward is good. It's not that the price is very, very far away from where we think we could make an entry, but we'll wait.
Thanks, Gagan. Again, and one last question which is there. Let me put. I think we have more 8 minutes in the con call to end. So I think one common thing which we have been seeing in the news is about IPOs, which is a favorite of the people are making money by investing into that, who are getting allotment. So the common question which is coming on that, is there any chance that we are going to participate in the pre-IPOs or on the IPO segment in our specialized portfolio?
So, from a regulatory standpoint, we cannot do pre-IPO or anchor book at all because we are put in the PMS side. That is possible only in the AIFs. So, unfortunately for us, it is only after the IPO is launched that we can, build out our positions, and many a times that means foregoing the listing benefit. So yeah, I mean, if IPO exposure has to be played, perhaps the right vehicle is AIFs rather than PMSs.
Participants, I think we have almost end of the session on the quarterly con call of the specialized portfolio. So thanks, Gagan. You explained about the portfolio, what are the changes we have done and everything also. And we have almost covered with all the questions which I think. Participants, if any questions has been left, you can write all the questions to us. Just email ID ce@askpms.in, so that if you have any questions which has been unanswered at this con call, you can tell. As specialized portfolio, last 1 year has been generated very good return, has beaten the benchmark with a very significant margin. And with the long-term point of view, we are looking into generating a very good alpha on an absolute basis point of view. So with this, we would like to end the con call. Thank you, Gagan, once again for taking your time. Thank you, participants, for you all in terms of taking of your time.
Thank you for your time. Thank you.